When we talk about AI infrastructure, what do we really mean? It's not just about clever software or robots from science fiction. At its core, AI infrastructure is the physical backbone that makes AI possible. This includes massive data centers, essentially giant warehouses of powerful computers. It also means specialized chips, like GPUs, built for intense calculations, and the high-speed networks and cloud platforms. Think of it as the roads, bridges, and power plants of the digital world. The US is ramping up investment for vital reasons. First, global competitiveness. Rivals are pouring billions into AI. It's about national security and economic stability, and unlocking future growth. History offers lessons on spending and inflation. In World War II, spending surged and jobs boomed, but goods were scarce under rationing. Pressure built on prices. Controls managed prices during the war, then prices jumped when controls lifted. The 1960s mixed social programs with Vietnam spending, injecting substantial demand. Without offsetting taxes, inflation persisted through the 1970s. In 2008, stimulus met a weak economy with slack, limited inflation. It propped up demand and avoided deflation. During COVID, trillions hit households amid supply shocks, driving a 40-year high inflation surge. That episode frames today's debate on AI spending, especially when investment targets AI infrastructure. To gauge AI's impact, look at the current economy. Inflation peaked in 2022-2023, then cooled markedly. Aggressive hikes tamed CPI from over 9% to roughly 2.53%, still above the Fed's 2% goal. The last mile is tough. The labor market is resilient. Unemployment hovers near 3.8%. Tech roles, data science, cybersecurity, AI remain strong. GDP growth continues modestly, avoiding recession. Growth fluctuates between 1.5% and 2.5%. A delicate balance, steady, not spectacular. Inflation is down, but not out. Skilled labor is tight. Growth is positive, not booming. New AI spending could tip the scales toward price pressure or productive growth. The heart of the AI revolution beats to the rhythm of silicon. The heart of the AI revolution beats to the rhythm of silicon. The heart of the AI revolution beats to the rhythm of silicon. Modern AI, especially LLMs and generative models, requires massive compute. Demand centers on high-end GPUs and accelerators, the most advanced chips ever produced. Global supply is tight. Bottlenecks persist. Policy aims to ease bottlenecks long-term, but near-term can fuel demand further. Public dollars join private buyers in a hot market, competing with hyperscalers to buy chips. Prices up, lead times stretching to months. Costs hit startups, universities, research labs too. Tech-specific inflation can pass to customers. Fabs take years and tens of billions, straining niche supply chains in the interim. Beyond microchips, AI has a massive physical footprint. These aren't office buildings, they're specialized facilities consuming enormous power and resources. A global construction boom is underway, fueled by incentives for more and larger facilities. New demand hits real estate, construction labor, steel, and concrete. Energy use is a major concern. One large AI site can draw power like a small city. Utilities warn of demand outpacing capacity. Higher demand can nudge utility prices up for homes and businesses. Localized inflation. Cooling systems, PDUs, and fiber are specialized supplies. Competition creates shortages and raises costs. Resources shift from housing to AI builds. Ripples spread to construction, housing, and energy. The explosion in AI has sparked a fierce talent war for highly specific skills: machine learning, data science, deep learning, and AI ethics. Giants and startups bid aggressively for talent, sending compensation to record highs. Government investment fosters innovation, but adds another buyer. Agencies, labs, and contractors all hiring. Salaries set a higher floor across AI roles. Recruiting gets pricier for everyone. Wage pressure spreads beyond AI. Training helps, but takes years. Short-term, demand outpaces supply. Wage inflation risk. Talent joins chips and data centers as core cost drivers, raising the cost of building the AI future. Rising tech wages don't happen in a vacuum. Highly paid workers spend locally. Housing, dining, services. Tech hubs see pockets of high inflation. Classic demand-pull dynamics. Rents and local prices can ripple outward. High pay reshapes expectations across industries. Firms lift wages to retain skilled staff. Costs pass through. But few earn top-tier AI pay. Nationwide effects are limited unless combined with hardware and energy pressures that keep inflation persistently warm. A challenge for the Fed without stalling growth. Spillovers can widen to neighboring areas. Localized heat can still lift broader costs. The risk: persistent low-level inflation, not a surge, but a stubborn glow. Will AI spending be inflationary or deflationary? The inflation case: huge spending meets limited supply of chips, facilities, power, and talent. Input prices rise and pass through to consumers. Another demand shock in a warm economy. The deflation case: productivity. AI automates tasks and reduces costs. More output, fewer resources. Prices can fall. Past waves expanded capacity and tempered inflation. Scale adoption could counter price pressures. Inflationary forces hit immediately. Productivity gains take time to materialize. Development, deployment, integration, then prices respond. Policy must bridge years of costs before benefits. Navigating the gap is the key challenge. In conclusion, investing in AI infrastructure is a high-stakes balancing act with big economic implications. Near-term risks center on demand surges for GPUs and specialized hardware, a data center construction boom, and a fierce talent market. These pressures can complicate the inflation fight. But this is investment, not mere consumption. If AI boosts productivity at scale, it can be deflationary over time. Expect transitional costs before full benefits. Success hinges on productivity, gains that expand output without stoking prices. Done right, it raises living standards and cements U.S. leadership. In the end, it's a balance we can't afford to get wrong.